wish you all a very happy new year. And it's wonderful to be back on the Centrum Wealth annual outlook discussion. And especially so because CY24 has been such a joyride, and probably towards the end, the sentiment got a little sour. Probably, after we had the US election results and probably a little bit of slowdown that we saw in the Indian economy. But be that as it may, and we will talk about it in greater detail with Shankar and Manish, but I thought we should set the ball rolling for this discussion on something that's been exceptional for CY24, and that's been the phenomenal surge in interest that we've seen in the very idea of investing in Indian equities, and probably I think most other asset classes as well. And I'm not referring only to mutual funds and SIPs, but we've seen a surge of interest in investing across asset classes and across sections. So I want to begin this discussion with you, Sandeep. From your perch, how are you viewing this sea change that we've seen in the concept of investing?
There's been a huge surge in investor interest. Let me highlight two parts to it. Part A, the retail investor interest, and Part B, the family office investor interest. Retail holdings, as direct holdings and indirect holdings through mutual funds, have surged 10 times over the last 10 years. Two, participation of investors across geographies, the regional dispersion of investors. Now it covers 99% of India's PIN codes. The total investor base crossed 10 crores as of August 2024. But in 5 months, it added another crore by December 24, making it 10.9 crore investors in the Indian market. In the calendar year 2024, 2.3 crore investors were added, which was the highest ever in any calendar year. Female participation in the investor base has been growing. Now it's 24% of our investors are women investors. The median age of the investor has decreased from 41 years to 36 years in the last 6 years. To family office investors, we now have 300 family offices across the country, up from 45 6 years back. The estimated assets under management of these family offices is close to $30 billion, and it's expected to grow at a CAGR of 14% over the next few years. Family office capital is patient capital. Besides financial backing, they bring in regional insights, regional experience, and which lends support to companies starting off. And this is going to be a huge play going forward. Now, importantly, we've seen investors being attracted to the markets given the returns over the last 3-4 years. I think which brings it to the discussion, how do we in Centrum Wealth see markets shaping up over the next few years? Shankar.
Sandeep, the point that you make on investor interest in India is, I think, a very global phenomenon. In fact, I'd even say that the last 4-year, the market performance that we have seen, to a large extent has been driven by this heightened investor interest. So what we have seen in the last 4 years, I think for a combination of various reasons, we have seen an everything kind of a rally where several asset classes have performed extremely well in the last 4 years. Now, while market performance on one side, I think fundamentally growth has also looked up much better because of monetary and fiscal incentives. I think last 4 years has been a period therefore of a supercharged kind of an environment, be it market returns or fundamental growth. I think somewhere in the last 3-6 months, for various reasons, I think that picture probably is changing subtly at the margin. It of course started with the US elections and what it is going to bring and how the new dispensation is going to think about policy and what it means for interest rates and so on and so forth. But importantly, it stoked this question not only in the US but in the rest of the world. So for instance, in India, we have seen in the last few quarters, because of fiscal and monetary considerations, there has been a little bit of a moderation in growth that has been seen, and that's getting reflected in the markets as we speak. The point right now is, I think somewhere the debate that is on and live right now is, was the growth in the last 3-4 years supercharged, super normal? Um, are we at a point where there is a cyclical slowdown that we are going through, a moderation, so to say? Or is this slightly more semi-permanent? Is this a more like a 2-3 year kind of a phenomenon? I think that's really what the markets are actually grappling with. But I'd say that there is another dimension to looking at this. The other way to probably to view this is, are we getting into a period of normalization? So therefore, it's not really about a slowdown, but it's more a normalization period that we are getting into. Probably this is where, somewhere in between is the nuanced reality that probably we are getting into. I think that's really the here and now problem for the market, and that's what the markets are trying to kind of grapple with. Therefore, you have seen a little bit of a time correction, you've seen a little bit of a price correction, and markets are very keenly looking forward to what is the outlook in terms of growth for the next couple of quarters, what is the outlook for the next fiscal 26, what are those parts of the market that are looking good. Somewhere I think there is a broad understanding at the back of the mind, maybe we don't want to acknowledge it so explicitly, but somewhere from an everything rallying kind of a market, it's probably going to be a little more nuanced going forward. I think that brings us to the point of where are those growth opportunities that are there in India, and therefore how should investor portfolios be kind of tilted towards. So I'm going to turn to Manish for that and pick his mind on what is he seeing, what are corporates telling him in their management commentary, what are the trends that he's seeing in the the third quarter results that are ahead of us right now, and how therefore is he kind of managing his portfolio strategy.
So Shankar, very interestingly, you mentioned this whole term about FY24 being kind of a roller coaster sort of a ride, and the last few months being a little bit of challenging market, witnessing a little bit of time correction, maybe absolute correction as well. And you're absolutely bang on that FY24 has been a year of two halves, much like what I expect FY25 to be. First half, the market was steamrolling everything in its way. There were a number of challenges. It's not like as if there were no challenges in the market. There were a number of issues that were cropping up from time to time. The general election mandate was not up to the mark as far as market expectations were concerned. There was a little bit of a challenge as far as the government capex allocation in the central government budget was concerned. But I think we just steamrolled everything through, and the market just kept rallying through and through. And in the second half, it seems as if like nothing can go right? And every concern that we could have envisaged, from credit growth softening to asset quality concerns coming up to consumption slowing down, I think we've seen everything playing out. And that has had an impact as far as earnings growth and earnings expectation also is concerned, where we've so far seen in the last 4 odd months about 4, maybe 5% sort of earnings cut from Nifty as far as consensus expectations are concerned. Which brings me to the second point that you made, whether this is really a temporary phenomena, it was 1, maybe 2 quarter sort of a phenomena. Are we going back to the 2013-2019 era where we kept expecting 20% growth from Nifty every year and we kept cutting it back to 6% every single year? So compounded 15-16% earnings cut every single year and living in what we called as a hope trade. Now, the point is the near term, absolute near term reality that Q3 is not going to be very different from Q2. It is going to be a challenging quarter. There are going to be concerns, sectors like auto, banks, NBFCs, the numbers, frontline companies, large sectors are not going to look very pretty. Now, then as an investor, what should your approach be in this market? Should we be waiting for another 3 to 4 months for the market to settle down and then build position, or should we be buying now? My sense is that when you look at the market and the reality that exists today and what it has been for the last 3 odd years, that sector rotation is going to be here to stay. So first of all, you have to be aware of that and you have to kind of play for that. For example, it's a great time to get out of FMCG stocks right now and start picking up autos right now. NBFCs, again, I would be buying. Hospitals, hospitality, right, airlines, maybe even some of these large cycle businesses, I would be buying all of these. But as an investor, The approach has to be that you have to swim against the tide and buy when everybody around you is despondent and when everybody is selling. So it's a great time to build a portfolio which is more bottom-up driven rather than top-down driven, because there are enough opportunities which are existing in the market where you can build a position from 2, maybe a 3-year perspective and gain enough equity and build positions where you can make enough money in the market. So I'll absolutely be going out shopping right now, disregarding all the near-term concerns that are there, because fundamentally, from a 3 to 5-year perspective, the Indian economy looks to be on a very strong path. We are the only country in the world amongst all the major economies that have been able to weather all the storms out, macro and global geopolitical.
So, from a fixed income perspective, I think there are three key triggers that seem to be driving market expectations right now. Firstly, is this whole thing about fiscal consolidation that seems to be coming through very, very well. I think the government is expected to kind of do a fiscal deficit of about 4.5 odd percent in FY26, which basically translates to a 40 basis reduction over the last year. So, from a demand supply perspective, I think it bodes quite well for government bonds, for yields. Secondly, is this whole idea of how inflation seems to be kind of coming down. It used to be quite sticky till about say 2-3 months ago. From there, we seem to have come down quite well, and it is expected that inflation will kind of settle down at about 4.5% by end of this fiscal, and that should allow RBI enough leeway to kind of cut rates. Right now, I think markets are expecting the RBI to cut rates anywhere by about 50 to 75 basis. So these two are important positives that we expect to play out for bond markets. The one aspect that seems a little uncertain is this aspect of FII flows into debt markets. With what's happening on US Treasury yields and what's happening on the dollar index, that space or that trigger can be a little uncertain, and we'll have to see how that plays out through the year. But net, the outlook for yields and therefore the outlook for bond markets in the year next seems to be very positive. So, if I were to look at it from what does this translate to a investment strategy for fixed income, clearly with yields likely to come down, I think we are quite bullish on duration strategies. In fact, we think there are some spaces even in the medium segment of the curve that offers a reasonable value. So, duration is one important port of call that we want to kind of play for in CY25. Coming next is the aspect of the credit environment, and I think Manish had alluded to that earlier. It's getting a little uncertain in the bottom of the pyramid, but we think it's probably it's going to take a few quarters, and until that settles, if you were to move up the curve, I think when you look at performing credit, whether you talk about manufacturing, whether you talk about real estate, I think the space over there is looking very interesting and offers some very interesting yields for investors to kind of lock into, especially given that you're expecting rates to kind of come lower in the year ahead. And the third basket that we find very interesting is these income generating asset backed securities. And what I mean by this is portfolios of physical assets, like whether you talk about highways, you talk about solar power assets, or you talk about something as simple as commercial office spaces. I think these segments are offering some very interesting yields, solid, good quality kind of assets. And from a 3-5 year perspective, investors who can kind of lock in monies from a 3 to 5 year perspective, I think some of these spaces offer some interesting kind of investment avenues. And lastly is this whole concept of gold. I think gold has taken a beating in the last 3 odd months. Thanks to what's happened in terms of the dollar trade, or what the Fed is expected to as far as rate cuts are concerned. So gold has been in a little bit of a weak spot, but over a medium term, I think from a 2-3 year perspective, if we kind of weave together the uncertainty that is there on global inflation and geopolitics, and a signal of that is what is happening with central bank demand and central bank purchases, I think gold remains very meaningful, and it continues to hold a very important kind of a place in our model portfolios. But I'll want to turn on to Shankar to ask him about what is he looking at, or how is he wanting to kind of build overall portfolios in the year ahead.
Yeah, I think the beginning is basically that over a medium term, I think we all agree that India remains a very attractive destination for several macro and micro factors. It's really so much about the here and now. I mean, how is CY25 going to be? And I think the one line that best encapsulates that to my mind is what a Fed governor said insofar as Fed policy is concerned for this year. He said we will cross the river by feeling the stones. I think it's a great line to kind of talk about how therefore investors should look at CY25. Uh, in that backdrop, insofar as portfolio strategy is concerned, we are entering the year with a tad bit of caution, given how things are panning out right now, whether it be immediate growth considerations, immediate considerations of geopolitics, immediate considerations on what is happening with regard to local politics, a few other issues. So therefore, in the immediate term, we are slightly underweight insofar as equity exposure is concerned. But within that, I think the context is really about kind of acknowledging the fact that the beta rally of the last 4 years, which is an everything rally when markets went up, all in one breath, that is probably behind us. We are getting into probably a phase of the market when it's going to be far more nuanced. So in that context, one of the key central themes of our equity portfolio is about sector rotation, where you are essentially saying that be nimble, look at opportunities where you're seeing fundamental growth triggers pan out in the next 4 to 6 quarters, and be willing to move there. And that's really what's going to contribute to alpha. Indeed, I think in the last 4 years as well, that's where we have seen our alpha accrue in our model portfolios. Other than that, we've typically maintained a 3-bucket approach, and we continue to kind of do that. At the margin, incrementally for us in the last, say, couple of quarters, we have bumped up our exposure to developed market equities. I think the story on US is getting stronger, over the last few months. Of course, valuation considerations are there, but I think growth is looking very positive. Similarly is the case in certain other developed markets in the world. So therefore, we have marginally increased our exposure over there. And then at a broader equity portfolio level, I think the point is, we saw from the number of IPOs in India in 2024 that a whole host of companies are growing extremely well and are very ready to hit the public markets. And so I think late stage private market ideas is a great space to be in. And within the private markets as such, I think we are seeing some very niche kind of opportunities in select segments. It could be something even as esoteric as something like deep tech, but we are seeing very good opportunities over there. So there is a generous allocation to that part of the market in our model portfolios. Within fixed income, I think Mangala covered it quite exhaustively. So, we are adopting a 3-bucket kind of an approach over there as well. So that's largely how we are actually building it. Watchful for the year, tweak as you go, and play it, navigate the CY25, but play for CY28, 29. That's really the way we are actually playing it.
So we've discussed outlook and portfolio positioning. How has it been for Centrum Wealth clients in terms of performance? Well, starting with you, Manish, in terms of equity performance.
So I think our strategy has been very simple, which is to play to our strength, which is primarily mid and small caps, and yet try and keep the risk profile as low as possible. So we operate with a beta of 0.8483. And what we've managed to do is to build portfolios that have been remarkably consistent over long periods of time across all cycles. And I think despite all the volatility that we saw in the second half of 24, we still managed to weather through and generate that alpha over the market, delivering a 20% plus sort of a return consistently year after year, every single year in our flagship product, which is good to great in the DPMS portfolio.
And Shankar, in terms of the overall performance, including besides equity, including all asset classes as well?
Sure. I think, Sandeep, we've been running model portfolios for the last nearly 6 years now. Every month we put it out and we measure the performance of what we have said 1 year, 3 year, 5 years, now 6 years ago as well. And it's very heartening to actually see that all our model portfolios are significantly outperforming their benchmarks. So therefore, if you were to look at the aggressive model portfolio, we run 3 model portfolios: aggressive, balanced and conservative. The aggressive model portfolio, we've beaten the benchmark by 6.4% per annum over the last nearly 6 years. The balanced model portfolio, we are ahead of the benchmark by about 4.4% per annum. And the conservative model portfolio, we are about 100 basis points above the benchmark. So I think overall it's been a fairly gratifying experience for our investors in the last 5-6 years.
Thank you so much for listening in, and we hope you have a wonderful CY25. A last point I'd want to make here is that please look out for the annual India Market Pulse, which is a survey that's brought to you by Centrum Wealth. It's a very interesting survey that actually gives you a sense of what some of the best brains in the industry, I think about 25 odd fund managers have contributed to the survey in terms of how are they viewing markets and how are they building their portfolios. And I can tell you it makes for some seriously interesting reading. So please watch out for that. It will be hitting your inboxes probably in another week's time. So that's it from our end. Thank you so much.